Hello and welcome. We'll give a few seconds to have everybody be lined up and on the screens. Hello again and welcome. My name is Kevin Kane with Stowe and Degon. Thank you for joining us today. This is another in our webinar series. Also, we'll be with Marty Croyle and Prasanna Kadambi today. Obviously, much is happening in the PPP and then tax implications world. Things are changing. They're changing very quickly. And we are staying right on top of it and presenting updated webinars as they make sense. So we, in terms of our questions and answers today, we welcome your questions. And you can ask your questions in two different ways. At the bottom, there is a Q&A box. You can type your questions into there. Or at the end of the webinar, you can ask those directly. In order to do that, just raise your hand at the bottom, and our moderator will ask you to unmute your microphone. If we cannot answer your questions during the webinar, we will subsequently respond to your questions by email or phone. The presentation today is being recorded, so if you would like a copy, please email us after the webinar. And also at the end of the webinar, there'll be a short survey that will appear on the screen, and please take a moment, if you will, to answer these questions. All the responses are anonymous and will help to make sure you are getting the most from our webinar series. Our presenters today are Prasanna Kadambi, CPA, MBA, tax partner, and Marty Croyle, CPA, MST, and partner. In terms of the agenda, the Consolidated Appropriations Act 2021, or more commonly called PPP-1 these days, will cover. The new PPP-2, known as the Economic Aid to Hard-Hit Small Businesses, Nonprofits and Venues Act, will cover. We'll highlight the changes to PPP-1 and the tax implications created by those changes, and we'll do the introduction to PPP-2. So at this time, I'd like to turn the program to Prasanna Kadambi.
Hi everyone. Thank you for taking the time to join us on this webinar. I would like to start off with the PPP tax aspect, since we've talked about this in the last two webinars. For people who haven't attended the first two webinars, just to give a 30 seconds background for those people. When the CARES Act was passed, Congress specifically included language that ensured that the debt upon forgiveness would not be considered taxable. But they didn't say anything specific about the expenses. The IRS tried to fill this blank out by issuing a notice saying that since the income is not taxable, the expenses associated with that income would not be deductible. Congress was against this position right from the beginning. They wanted to ensure that the small and medium-sized businesses, there was still liquidity there. And they asked IRS to reverse this position, and the IRS refused to do it. So they fixed that issue in the Consolidated Appropriations Bill. They expressly added language that would make the expenses deductible both in PPP-1 and PPP-2. Initially, they were going to add some guardrails there whereby the expenses would be deductible only if the revenues decreased for the year. But they did not end up doing that. So all of the PPP expenses are now deductible. So what does this mean? I mean, if you borrowed $1 million worth of PPP loan, the IRS was of the opinion that you'd have $1 million of non-deductible expenses. But with this bill having been passed, you're now going to be able to deduct those expenses. And that leads to an additional tax benefit of $300,000 to $400,000 at the 30 to 40% tax bracket. So we do have a favorable outcome from a federal standpoint. So now we have to take it one step further and look at it at the state level. Unfortunately, all states don't automatically follow what the federal government does. So some states specifically have to pass some sort of a bill in order to make these expenses deductible and make the income non-taxable. If we look at Massachusetts, Massachusetts is unique in the sense that from a corporate standpoint, Massachusetts has what is called a rolling conformity. What that means is that it follows the latest federal code. So we should be good from a corporation standpoint, where we would kind of follow what gets done at the federal level. But at the individual level, Massachusetts follows the Internal Revenue Code as of January 1st, 2005. From time to time, Mass passes bills specifically to deal with updates that have happened since 2005. They have not passed anything related to this topic yet, so we have to keep an eye on what happens at Mass at the individual level. But in Massachusetts, it's the forgiveness of the debt that creates taxable income. So for people who have not received forgiveness until December 31st, 2020, you have some more time to deal with this problem. So going back to the same $1 million example, once you receive forgiveness of $1 million, you might have tax in Massachusetts of $50,000. It's a little bit better than what we had the answer before, but it still doesn't fully solve the problem. So hopefully Mass will get together and pass a bill and kind of follow the federal on this topic. We've reached out to the Mass Department of Revenue in order to kind of get their latest guidance on this topic. So once we hear more, we'll obviously keep you guys updated. So that's where we are at from a PPP standpoint. Best possible answer from a federal standpoint. Still need to get more guidance from Massachusetts, but something needs to be done through a bill in order for the income not to be taxable in Massachusetts. The other provisions, so besides the PPP, there were some other provisions in the Consolidated Appropriations Bill. One of the things is the basis step up. Congress has ensured that the tax exempt income that would be the result of the forgiven debt would lead to an increased basis for the S-Corp shareholders and the partners of the partnership. So what does that mean? So going back to our $1 million example, if you have $1 million in forgiven debt, it leads to $1 million of tax exempt income. Tax exempt income does increase a shareholder's basis and a partner's basis in the S-Corp and the partnership. So in other words, it gives you the ability to take out an additional $1 million worth of distribution tax-free. And if you're, say, in the process of selling your business, that kind of goes against the capital gains calculation. This was going to be our position anyways, but I'm glad that Congress has made this expressly clear in the bill. The other thing that was in the bill was the Section 7A loans. Some of our clients have received the 7A loans in addition to the PPP. The Section 7A loan essentially allowed SBA to pay your mortgage for 6 months. In the original CARES Act, this was supposed to be taxable income. And some clients had even received notifications from banks that they were going to issue 1099s for this. Congress has gone ahead and allowed the payment of the principal to be non-taxable and no deductions to be disallowed as a result of this income forgiveness. So that's another positive news for people who receive the 7A loans. Some people also received the EIDL loan, which I believe is the Economic Injury Disaster Loan. The $10,000 advance that was excluded, they've also added language in here that specifically excludes the $10,000 advance from income. And no expenses are disallowed with respect to the income inclusion. The second most beneficial piece in the appropriations bill is the employee retention tax credit. And there are two parts to this, one for 2020 and one for 2021. So let's call the 2020 the ERTC-1 and let's call the 2021 ERTC-2. So with regards to ERTC-1, this is a refundable payroll tax credit for retaining employees during the pandemic. Previously, this was available only to businesses that did not take the PPP loan. With the appropriations bill, this is now available to people who took the PPP loan as well. In fact, to qualify for the credit, you have to satisfy a couple of conditions. The first condition is the employer must have carried on trade or business during the calendar year 2020, which should be most of our clients. The second piece of the condition is the operation of the trade or business was fully or partially suspended due to orders from appropriate governmental authority, which would probably be the gyms of the world, or if you had a 50% reduction on a quarter by quarter basis in your income. So, and you compare it to your 2019 quarter to quarter income. So in other words, if you got the PPP loan and if you satisfy those conditions, you might have not done anything with this credit in the past, but there is an opportunity to get an additional $5,000 credit per employee. The only caveat is that you cannot use the wages paid with the PPP money for this credit. The other good thing is you don't have to go back, and since this is a payroll tax credit, you'd have to kind of get that amount through payroll tax returns. But the good thing is you don't have to go back and amend your payroll tax returns. You can claim this credit in the Q4 of 2020 payroll tax return, which wouldn't be due until January 31st of 2021. So we encourage you guys to work with your payroll service provider if you feel like you satisfy your conditions. Again, we are here to help answer any questions. We are here to help do any calculations for you guys. One thing to keep in mind is that if you are like in the border where you qualify for, where you don't fully qualify for the credit, in terms of the ordering rule, the ERTC wages goes before the PPP wages. So if you have already filed for forgiveness, but you are planning to take this ERTC1 credit, might have to kind of revise your PPP forgiveness application. Again, we'd have to put numbers to paper since everybody's fact pattern is going to be a little bit different. But again, we are here to help answer any questions. So that's kind of ERTC1, potential $5,000 benefit per employee for the year 2020. ERTC2, which is available from January 1st of 2021 to June 30th of 2021. They not only made the credit easy to avail, they also increased the amount of the credit. In order to be eligible for the credit in 2021, your revenues should have dropped only by 20% when you compare it to 2019. And the credit on ERTC1 was $5,000 per employee for the whole of 2020. Here, the credit is $7,000 per employee for each of the first 2 quarters. So it's essentially a $14,000 benefit. In ERTC1, you would not qualify for it if you had more than 100 employees. In ERTC2, you qualify for it if you have less than 500 employees. So overall, we encourage everybody to look at this employee retention tax credit a little bit more closely. Like I said, the ERTC1 credit is $5,000 for the year 2020 per employee, and the ERTC2 credit is $14,000 per employee for the year, for the first, including the first 2 quarters. Besides the employee retention tax credit, the other thing that was taken care of in the Consolidated Appropriations Act was at the outset of the COVID-19 pandemic, Congress had passed the Families First Coronavirus Response Act, which required employers with less than 500 employees to provide paid leave to employees who were directly or indirectly impacted by COVID-19. This FFCRA expired on December 31st. Though Congress chose not to extend the leave mandate, so employers are no longer required to provide COVID-19 related leave under federal law, but they are encouraging employers to provide by extending this tax credit to covered employees. I know several of our clients have availed the benefit of this credit in the past few months since we've gotten several questions on this. This credit is now still available till March 31st of 2021. So we again encourage people to take a look at this credit. Again, we are here to help answer any questions on this topic. The other thing that they passed in the Consolidated Appropriations Act is the meals. Restaurant meals are 100% deductible for the year 2021 and 2022. This is obviously to kind of give a boost to the restaurant industry. So those were some of the major highlights with regards to Consolidated Appropriations Act. One of the things that we wanted to also talk about Greg, if you can go to the next slide, is that since the Democrats won the Georgia Senate, we wanted to highlight some of the tax proposals that Biden had suggested before getting elected. So we just wanted to kind of point those out. One of the things is obviously the individual tax rate is going up from, or they would like for it to go up from 37 to 39.6, which was the rate when Obama was president. They're going to cap the itemized deductions at 28%, which would increase everybody's effective tax rate. They would phase out the itemized deduction with income over $400,000, which would again increase the effective tax rate. They have proposed to increase the child tax credit and the dependent care credit. One of the big changes that might impact a lot of our clients is they're looking to push the capital gains rate to ordinary income tax rate for income above $1 million. So if anybody has a huge built up gain in any of their investments, something to keep in mind. If the rates go up, then you might end up paying, right now the rates, including the state rate, is 38%. And this would push it up to like almost 45%. So that's a big difference. Excuse me. In terms of corporate rates are currently at 21%. They want to bring it up to 28%. They want to reinstate the corporate AMT that the Tax Cut and Jobs Act had gotten rid of. Can you go to the next slide, Marty? They want to eliminate the basis step up that happens for estate tax returns that happens upon death. They also want to kind of, the FICA tax that everybody pays through their wages, it goes away when income reaches $137,000. They want to bring it back when income goes above $400,000. So overall, there are a lot of proposals out there which should increase the overall tax rate or the effective tax rate for a lot of people. So something to think about and see if there is any income that you want to accelerate in 2021. Again, nothing's been passed yet, but just wanted people to be aware of. With that, I'm done with the tax side of it. I'll pass it on to Marty to talk about PPP-2.
Thanks, Prasanna. Great job on a lot of difficult and upcoming tax things. I'm Marty Croyle. Happy to be here again to talk about PPP Round 2. It's called Second Draw. It's called PPP-2. They're synonymous terms. I'm going to refer to them as PPP-1 and 2 in my remarks. So for the next 15 minutes or so, I'm going to talk about an overview of PPP-2, okay? The Economic Aid to Hard-Hit Small Businesses, Non-for-Profits, and Venue Act, I don't know who comes up with these names, that's the one, that's the bill that was passed at the end of 2020 that set up PPP-2, okay? It is approved. It took a long time to get it approved, but it is now here and it's beginning to be rolled out. And I would suspect that most people should be talking to their banks to find out when the banks will begin to be accepting their loan applications for PPP-2. This past week, we woke up Thursday morning to two interim final rules. We call them IFRs. I don't know why they keep calling them final rules because I keep updating them, but we got two of them on Thursday morning, and they were probably 130 pages of verbiage explaining to us what the acts was all about and what PPP-1 and 2 were going to look like compared to each other. On Saturday, we got the new application form for the second PPP loan. It is now going to be on form 2483-SD. So we spent a lot of time in the last few days pouring through this stuff. We're going to give you the best information that we have as of today. It's fluid. We expect more information, more IFRs from the SBA and the Treasury as time goes on. So for the rest of my remarks, I'm going to talk about PPP-2, the loan application and forgiveness process. And this is the process I would go through with a prospect or a client to figure out if they can get a loan and how much. First, we have to figure out if they're eligible. Then we have to figure out how big the loan will be. Then they will then fill out their application form and submit that to their lender. There are a few other provisions which we'll talk about shortly that I think you'll find interesting. Then we're going to talk about forgiveness, because there's going to be forgiveness here just like there was with PPP-1, as Prasanna said, and we're going to end with talking about the eligible costs. And a lot of these terms are familiar to any of us who have been involved with PPP-1. So compared to last March and April, when all this was brand new to the borrowers, to the banks and the other lenders, and to we accountants, this is all, a lot of this terminology we now know. And we're going to find, I think we're going to find that PPP-2 is going to be a lot easier to roll out than PPP-1 was. Now, there are changes, but there are more similarities than changes. So I'm now going to walk through each of the pieces. So first thing we have to figure out is, are you eligible to get a loan? Are you eligible to get a loan? And just because you got a loan in PPP-1, that is no guarantee you're going to get a loan in PPP-2. So I'm going to do this a little backwards, it might seem, but I think hopefully it'll be effective. We're going to talk about what is an ineligible company. In other words, what companies can't get a PPP-2 loan, or what criteria will prevent a company from getting a PPP-2 loan. So first one is entities that are permanently closed. So I'm sure there are companies in this country that back last March and April received the PPP, applied for and received a PPP-1 loan, spent that money on payroll and other eligible expenses, and then had to close their doors. If they have been permanently closed, the SBA specifically said in this last act at the end of December that they cannot get a PPP-2 loan. Secondly, the economics aid to hard-hit businesses also laid out a shutters venue operator grant. Now, this is a grant that live venues, and these live venues would be, think about a museum, think about a theater, think about a zoo. If those entities apply for a shutters venue operating grant and get it, they cannot also get a PPP-2 loan. Now, the next is going to just be a pile of characteristics or specifically type companies. These people can't get a PPP-2 loan. So if your entity has any of these characteristics, there's no going forward with you. And you might want to excuse yourself from the rest of this webinar because you can't get a PPP-2 loan, okay? Now we're going to turn to what's an eligible company. Now, it's fair to say that the PP2 is more restrictive than PPP-1. And there are two major things that make it more restrictive. PPP-1 allowed a company, general rule, to have 500 employees or less. PPP-2 now has cut that to 300. So if you were a company that had 450 employees back in March and you applied and got your loan, and now you still have 450 employees, you cannot apply for a PPP-2 loan. The SBA has also added a calculation. We got a little math here. Gross receipts. Think of revenue and other income that you would have. To qualify to apply for a PPP-2 loan, there has to be a reduction of 25% or more of gross receipts in any quarter in 2020 as compared to that applicable quarter in 2019. So for example, I think a lot of companies probably saw their worst quarter in the second quarter of 20. So it'd be April, May, and June of 2020. You would compare the gross receipts, which we're going to define in the next slide. We're going to compare those gross receipts in 20 as compared to that same time period in 2019. If you've had a drop of more than 25% in the second, third, or fourth quarter, first quarter for that matter, then you technically qualify to apply for a loan. Now, I want to throw out a fact pattern, and I don't know the answer to this question, but there are companies that I know of that got hammered in quarter two. Their revenue might have been down, their gross receipts might have been down 30 or 40%, but they rebounded in quarter three and quarter four. And perhaps it's because they pivoted and they sold different things, or maybe they were lucky, or maybe they were in the right industries. Are they going to, and let's just say that at the end of 2020, they get close to the revenue they had in 19 for the whole year, or they equaled it, or they were even better. Are they still going to be able to get away with this one quarter look where they got hammered? I think so, but I'm not 100% sure. So I just want to throw up, this was the act, and I've highlighted in bold, hard hit. A lot of people in Congress during the summer said a lot of companies got PPP-1 loans that probably shouldn't have. Maybe they weren't hard hit enough for some of the senators and Congress people. I don't know. And this, on your PPP-1 loan application, and the same thing goes for your PPP-2 loan application, the borrower has to assert to many certifications, and this is one of them. You're basically saying, we got economic problems and we need this loan. So the only thing I'm saying here is if you've had a big dip in one quarter, it looks like you're qualified to apply for a loan. But I just wonder if we're going to see another shoe fall here, because there was a lot of complaints in Congress over the summer. So we'll have to wait and see about that. So now we have to figure out this gross receipts test, because we got to do this 25% reduction. So this is what has been defined in one of the recent IFRs from last week. And most of this stuff is going to be obviously simple and make a lot of sense. It's the sale of your product and services. The term is received or accrued. Translation, received is cash basis, accrued is accrual basis. Then there's this language in the IFR. It says, in accordance with the entity's accounting method. Now, we have a lot of clients who keep their books, their internal records on the accrual basis. They file their tax returns on the cash basis. And the question is, which is their entity's accounting method? We have some indications of what that is, but we are expecting a little bit more guidance here. Because if you calculate your quarter by quarter calculations for gross receipts, you're going to get different numbers for cash basis than accrual. So we will work to get a better understanding of this for everybody. Hold on one second. Okay. Also included in gross receipts are the following items. So these are things that the SBA says you have to include in your gross receipts calculation to compare 20 to 19. And you get to reduce these numbers by sales and returns, which makes sense, okay? And when you get a forgiven loan for PPP-1, as soon as the SBA approves that forgiveness, the debt goes away from your books and you're going to create other income. And as Prasanna said, it's not taxable, but on your books, it's going to be book income. The gross receipts test allows you to exclude that forgiven amount from this calculation. And finally, you get to exclude all capital gains and losses in this calculation. So that's what gross receipts are. So the reduction, it's worth repeating. We talked about it a couple of slides ago. We have to go through and calculate whether or not we've had a reduction of more than 25% or more of gross receipts in any quarter in 20 versus that same applicable quarter in 19. Now, the IFR that just came out also says that for simplicity, if a borrower would rather just compare their total 2020 gross revenues, or gross receipts, it should say, to 2019's annual gross receipts, they can do that. Because some taxpayers, some borrowers may not have the sophistication to do monthly and quarterly statements. They'd rather go with the annual. Now, the IFR allows for this. The problem is that the application form for the PPP-2 loan doesn't allow for this information to be included. So what I suspect most people will do is the quarterly thing, but you do have the annual option. And for the annual option, I wouldn't be surprised if there's some further guidance from the SBA to allow that to be included in the application form. So we've now figured out you are now eligible, and now we're going to figure out how big your loan calculation is going to be. And this is going to be very similar to what we went through, or you went through if you borrowed money on PPP-1. The loan now, the amount of loan you can borrow from the SBA is going to be the lesser of your 2019 or your 2020 average monthly payroll times 2.5. Now, when we did PPP-1, we went back, most borrowers went back and figured out their 2019 average monthly payroll, and they multiplied it by 2.5. This year, we can either use 2019 or 2020. Now, my guess is that unless your amount of payroll went up in 2020, I think most borrowers may end up using the 2019 numbers that they've already calculated. If that's what they're going to do, that's going to save you a lot of time as you prepare for this application form. So you're going to take that average monthly payroll times 2.5, and you're going to compare it to a maximum of $2 million. That's down from 10 million. So PPP-1 allowed people to borrow up to 10 million. This time around, it's going to be capped at $2 million. Now, the average monthly payroll calculation is almost identical to the PPP-1. I think there's a few nuances, but not worth getting into in this overview. And finally, if you are in the hotel and food area and you have an NAICS code starting with 72, you can multiply your average monthly payroll times 3.5, not 2.5. And the SBA just believes that the restaurants and the hotel industry has been hammered so much that they should be able to borrow a little bit more money. So that's how you figure out your calculation. Very similar to what we did in round one of the PPP. So now it comes time to fill out your application. So as I said, the application form was just released on Saturday. It's form 2483-SD. Now, please note, this needs to be filed by March 31st, 2021. So that's right around the corner, all right? Now, as I think Kevin said, or somebody might have said, we're going to send you after this presentation a copy of the 2483-SD application. They're going to be it's going to be one email. It's going to have two parts to it. It's going to be a clean version of the 2483-SD, and that's going to be a repeat of that. And the second one's going to be highlighted in yellow. Anything highlighted in yellow are changes from the original PPP-1 application form. Some people were very intimate with that form. We just want to show you how it's changed. And there are changes, but not tons of them. Other provisions that I think are worthwhile talking about. The PPP-2 loan application can be filed before applying for your PPP loan forgiveness. Now, I don't know, but I suspect a number of our clients still have not filed their PPP loan forgiveness the documents to their lender. But the IFR says that if you haven't done that, you can still apply for your application before you've applied for forgiveness for phase one. Filing the PPP-2 loan application will with the same lender can save you a lot of documentation time, particularly if you use the 2019 average monthly payroll that we talked about a couple slides ago. Because if you decide to use the 2019 average monthly payroll, and you're going to end up using the same lender, the lender should have all this information, and so therefore you don't need to probably send all this documentation in. But if you decide to change lenders, which is great, which is fine, and or you decide that you're going to use the 2020 calculation, then that's documentation that you're going to have to pull together like you did in round one and send it off in round two. Hopefully that made sense. Now, if you'll all remember back to PPP-1, when the forgiveness rules first came out in May, the SBA said you have to pay all your eligible expenses in an 8-week period. There was a lot of pushback on that. And then in June, they came out with revised rules and said, okay, or you can pick 24 weeks. So you had the choice, either 8 or 24 weeks. And what we recommended to people back then during the year was to pick the longer period of time, because that gives you more time to pay more eligible expenses to make your loan forgiven entirely. Now the new rules with this latest IFR is you can pick any time frame between 8 and 24 weeks. So the way I read that is you can pick 12 weeks or 16 weeks or whatever. I suspect we're going to get this question a lot. My off-the-cuff answer at the moment would be I'd pick the longest period you can, because the longer the period, the more costs you can pay, and you'll have a better chance of having your loan forgiven. Prasanna mentioned this. The EIDL advances, which are often capped at $10,000 per company, they're no longer going to decrease your PPP forgiveness. So for some people, they're going to get an extra $10,000 back than they had expected they would, because the new acts changed that. And finally, there are some new categories of people that can entities that can get PPP loans. And one of them is a 501c6. Now, this is a nonprofit. Think of a trade association, think of a chamber of commerce. I know they were all very disappointed that they were not eligible for PPP-1. They are now eligible for PP loans. Now we'll talk about forgiveness. Forgiveness is, as Prasanna said, the Appropriations Act did say that there will be forgiveness. And we expect the forgiveness for PPP-2 to be very similar to the forgiveness that we had in PPP-1. There will be some changes, I'm sure, but for the most part, they will be very similar. So what a borrower has to do is they have to accumulate during their covered period that they choose, and that this second round is going to be any time period between 8 weeks and 24 weeks. You're going to accumulate all of the eligible costs that you paid, and you're going to present that to your lender. And that amount will, the longer the covered period you choose, the higher that eligible cost number will get. You're going to compare that number to your loan. And if it's in excess of your loan, you're going to have the whole thing forgiven, hopefully. Okay. Now we're going to talk about what's an eligible cost in a minute, but let's keep going here. Like in PPP-1, PPP-2 loans say that 60% of your loan that you get has to be spent on payroll things, which means there's a lot of eligible expenses which aren't payroll, which we're going to get into in a minute. But at least 60% of your PPP-1 and 2 loans have to be spent on payroll for your loan to be forgiven. And as Prasanna mentioned, but this is worth repeating again because this is good news, your forgiven PPP loans will not be taxable, and the eligible expenses that they help fund, like payroll and rent and things like that, they will be deductible on your 2021 tax returns. At least that's what we're expecting. And if you borrow less than $150,000 this time around on PPP-2, you're going to have a simplified form to fill out. It's probably going to be 1 or 2 pages. It's going to say something like, we borrowed $137,000. We incurred a decrease in gross receipts in Q2 of 2020 compared to 2019 of 29%. And we spent all of our loan proceeds on eligible expenses, and just sign it. And that should get you full forgiveness. If you're more than 150, you're going to have to fill out a form, very much like what many of you have already done or are in the process of doing for round 1. We expect a lot of interim rules coming out from the SBA in the coming weeks and months related to the forgiveness part, because the IFRs did not specify as much as they did about the borrowing part. So let's now look at the eligible costs that your loans have to be used for you to get forgiveness. They're going to be very similar to PPP-1 rules. The biggest item, as you recall, is payroll. Now, this has been clarified a little bit to include group life, group disability, group vision, and group dental. But I don't know if that's going to be a huge number for a lot of companies. But for the most part, payroll costs. And I think what we found, a lot of people, a lot of our clients were able to just come up with payroll costs in their forgiveness calculation and not have to deal with the rest of these items to get full forgiveness of their PPP #1 loan. The other things you can spend your money on that are not payroll are mortgage interest, rent, and utilities. Those are ones that we recognize from PPP-1. And finally, the SBA in this latest interim rule added 4 new categories. Okay, and I'm going to read to you what they are. They're covered operations costs, and they would be things like software or cloud-based accounting. There's covered property damage. If you've had some damage to some property that's not covered by insurance during this period, you can use that. You can use covered supplier costs, and the last one is covered worker protection. And that would be like a restaurant having to put up the plastic barriers between the tables and things like that. All of those things can now be deemed to be eligible costs. Again, 60% or more of your loan has to be spent on payroll related. So that's a brief overview of PPP-2. So just to reiterate what, to summarize this topic 3, PPP-2 and 1 have many similarities, but there are some differences. There are some more restrictions on the number of people. It's gone from 500 down to 300. The maximum loan has gone from 10 million to 2 million. And the biggest difference is that you're going to have to show that you've had a decrease in gross receipts of more than 25% or more in any quarter or for the whole year between comparing 20 to 2019. As we said at the outset, this is the best information that we have as today. We will continue to monitor this and have more webinars or emails out to you as needed. And now I'm going to turn it back to Prasanna, and he's going to handle the Q&A part of the rest of our topic. Thanks for your attention.
Thank you, Marty. That was awesome. There are quite a few questions in the chat box. I'll read out the question, and then and depending on which topic it is, either I or Marty can answer it. So the first question is, if we are an S Corp and our PPP-1 has already been forgiven, does that mean that the state of Massachusetts will tax that PPP income to the owner of the business who lives in Mass? So, well, I guess in assuming that the S Corp and the individual are in the same, the S Corp is in Massachusetts and the individual lives in Massachusetts. S Corp is a little bit unique in the sense that S Corps follow, like corporations have the rolling conformity, so they follow the federal. So S Corps sometimes can have a 3% entity level tax within Massachusetts. That I believe that 3%, based on how the rules are right now, that 3% should be okay because it follows what the federal does. But the income flows through to the individuals, and that 5% tax at the individual level, that might create income for you based on how the rules are. Again, like I said, the S Corp is a little bit more trickier based on how the rules is written, but again, we have our eyes on this topic, and we've reached out to Massachusetts to get more clarity on it. So once we hear more, we'll try to get you a better answer. But in terms of an S Corp that's not in Massachusetts, I think we'll have to kind of talk offline because again, we haven't looked at this in terms of the rule, in terms of all the 50 states. So I think depending on where the S Corp is located, the answer could change. Marty, did you add anything else to add on it?
Well said.
Okay. So the second question is, so if we have already submitted the PPP forgiveness, we have to make sure to exclude the wages we used on forgiveness application from the ERTC-1 credit. So again, there's not a clear answer on this yet. So the way the rules are written right now, in terms of ordering that it has to follow in order to figure out if you are eligible for this, for a second, let's assume that you do qualify based on the rules and conditions that are there. The way the rules are written right now, you have to use ERTC wages before the PPP wages. There is an election to file where you can use the PPP wages first, but the problem is that they haven't issued any guidance as to how to make this election. So philosophically, we'll have to kind of wait a little bit more in terms of guidance with regards to this topic. The third question is, the $5,000 is all for 2020, and the per quarter was not retroactive. I'm not sure if I fully follow the question, but my understanding is that there is a $5,000 credit for the whole of 2020 available. And it is retroactive. So it starts from March 13th, I believe, to December 31st. So you'll have to kind of look at your wages for the whole year and then figure out if you qualify for both the PPP piece of it as well as the employee retention tax credit. I did get another question from people asking to send more guidance on the CRTC. So we'll put something together and email it out to the audience on this topic. The next question is, on the 2020, the employee retention tax credit, do businesses need to meet all of the requirements? Open in 2020, fully or partially suspended by government, 50% reduction in revenue, or just one or more of those requirements? So it should be open for the whole of 2020, and it should satisfy one of the other two conditions, which is fully or partially suspended by government or 50% reduction in revenue. And is it 5,000 for the year or each quarter? So it's like I said, the ERTC-1 that's available in 2020 is $5,000 for the whole year per employee. The ERTC-2 that's available in 2021 that's $7,500 per employee per quarter for the first 2 quarters. Anything else, Marty, you want to add on this?
I think you said that perfectly.
Okay. You talked about EIDL advances. What about standard EIDL loans? Is that a factor in eligibility? So anything that's a loan really has to be repaid. So the tax exempt income or the deductions don't really come into play with regards to that. So if you borrowed money, you used it for payroll or anything else, everything should be deductible because you're really paying that money back for both federal and state. I think the next few questions, Marty, are related to PPP-2, so let me read it out to you. Do we add or subtract the amount paid in interest and dividends, rents and royalties, fees and commission for 2019 and 2020 to the gross receipts?
Yes, you add them. The only thing that you would exclude is your forgiven PPP loan number 1. When you get forgiven, it becomes income on your books. So you would remove that, and you would remove any capital gains that you might have. But all those other fees, interest, dividends, they all get added to your gross receipts for both 2019 quarter and the 2020 quarter.
Okay. The next question is, are there still caps on the wages paid, specifically to owners? Are medical insurance premiums paid for owners not allowed as expenses still?
Well, clearly, the annual salary for anybody is capped at $100,000. I have not seen anything about reducing the S corporation owners number below that, but I suspect it's coming. If it's not, it might be there already. I don't know. What was the third part of that, Prasanna?
Are medical premiums paid for owners not allowed as expenses still?
I also didn't see that in the IFR this week, but I suspect that will be the same, and it will not be allowed because it's part. That's for the S corps. Prasanna.
Yeah.
Because that's going to their health will be included in their W-2, so that should be excluded.
Okay.
Do you agree with that, Prasanna?
Yeah, I think that makes sense to me. The next question is health insurance included as a PPP expense? So that's obviously a yes.
The employer portion of it, yes, will be included in the payroll cost to help you determine what your average monthly payroll cost is by month, either in 2019 or 20. That would include the employer portion of health insurance paid for the employees.
Okay. The next question is, I think we talked about this yesterday, Marty. So what if our total revenue is flat, however, in a quarter we were down 25%? I think the answer is yes, you do qualify for it.
Yeah, I mean, I just tried to alert people to the concern that I've heard out there that maybe that 25% rule all by itself might not be enough if you've actually ended up having a really good year. But so far, I haven't seen anything that says that you don't qualify if you've had a bad quarter. I don't know if that was the spirit of the hard hit act, but that's what it looks like so far.
Okay. I think this is a question we talked about too. I know we speak about quarters, but for us, March, April, and May was the biggest loss. Can I use those 3 consecutive months, or does it have to be normal quarters? In other words, is rolling average okay versus using those regular quarters?
So I think what this person's saying is if we look at Q1 and Q2 and Q3 and Q4, which are January to March and April to we don't qualify, but we'd like to take 3 months that cross over normal quarters. I have not seen that in the literature. Now, I don't think that necessarily makes sense, but everything I saw in the IFRs was quarters. So unfortunately, I think this questionnaire is going to be disappointed. Maybe there'll be more guidance on this, but at least that's what it looks like so far. But we'll take a look at that.
Okay. The next question, have you heard anything about the ability to amend the round 1 PPP if an error in calculation was incurred, and what is the process to amend?
I think you can amend. I don't know what the process is, to be quite honest. There have been some changes in the PP2 that might allow for changes in that first PPP-1 calculation, or you might have done something wrong. So we can look. I know that I do believe that you can now go back and ask for more money on your PPP-1 loan. I just don't know the process.
All right, I will ask this question. We'll look up internally and we'll try to get back to you on that. So I have the name written down. The last question is for the 25% gross receipt reduction calculation. Are management generated sales figures adequate for companies that only publish half and end year financials?
I would think so. I mean, I think that the SBA has the right to come in and make sure that you didn't fiddle around with your quarterly numbers to push revenue from one month to another month. But I would think that you would go with your internal records.
Okay.
Marty,
There were a couple of other questions that I kind of answered in the chat box, but I can take it one more time. Do you see these proposed 2021 tax changes being made retroactive to 1/1/2021? I think they are within their powers to do it retroactively. I would say historically, they have mostly done it prospectively. It usually is bad optics to do it, to go back and change the rules. That's why when they passed the Tax Cut and Jobs Act 2 years ago, they were in such a hurry to get it done before December 31st. So usually they've done it prospectively, but who knows? I think those were all the questions in the chat box. Greg, if anybody has their hands raised, can you kind of call them out? And
no one has their hands raised except for someone who had typed in a question. So I think we're good.
okay. All right, if nobody has any other questions, then we appreciate everybody taking the time. We'll continue to monitor things for things that are still a little bit open. And we'll keep you guys updated as we hear more. Thanks, everybody.
Thanks, everybody.
Thank you.